Hi everyone, welcome to our market outlook for the month of June. I'm Vivian and I have here with me Steve Bryce, our Chief Investment Strategist. Welcome, Steve.
Thank you.
One of the key themes at the moment is the outlook for US monetary policy. When do you see the Fed starting to hike interest rates?
Well, I think there's two aspects that are really important here. Firstly, when do they start hiking interest rates? But probably actually more importantly, the pace at which they will proceed once they start. And on the first point, our central scenario is still that we see September as the first rate hike. The risks, again, are still delayed, that it will be delayed until later rather than being brought forward. And that's just a function of the weak data we've seen in recent times. We're pretty confident it's just a soft patch and we'll see a re-acceleration of US growth. But the Fed will probably want to ensure that that's correct before they hike. What we are getting very strong signals is that we will see rate hikes being fairly modest and gradual. And I think that's really important when you're looking at financial markets. So maybe some volatility we'll see around the first rate hike, but I think we should be able to see equity markets, for instance, rally thereafter.
We're heading into a seasonally challenging period for equity markets. How do you see things evolving over the summer months?
It's always difficult to judge exactly when we'll see volatility. We do expect volatility at some point. If anything, we probably feel that we're going to see markets do pretty well in the very short term, so over the next 1, 2, possibly even 3 months. Greece is obviously a key concern for investors, but we really think that's not going to be that big an issue, and that may actually, the alleviation of concerns there may help push equity markets higher. Later on, around the timing of that first Fed rate hike, around August, September, that's probably when we're more likely to see that volatility coming through, which could actually be quite significant. So investors need to take that into account.
What potential strategies would you recommend investors to consider in the coming months?
I think there's two real strategies that people can consider. Firstly, investing in asset classes that they believe will do reasonably well over that period. In our view, there's two areas that we're really focused on. They're not new areas, but probably particularly interesting during that build-up to that volatile period. So firstly, covered call strategies within equities. You do cap the upside possibilities by doing this strategy, but you also help soften the blow on the downside if we do see volatility. So from that perspective, we see covered call equities as quite an interesting strategy. And then the second area is Chinese renminbi bonds. If you remember back to the taper tantrum in 2013, we saw very few asset classes do well during that environment, and Chinese renminbi bonds were one asset class that did. So that's probably a good place to sort of hunker down a bit if you're worried about increased volatility. The second strategy you can employ is a buy on dips mentality. From our perspective, that's still very valid. We still see global equities in a bull market for the next 12 to 24 months. So buying on the dips is still valid, either within global equities or within a diversified income portfolio. So from that perspective, buying on dips is probably a decent way to go as well.
What is your outlook for the China equity markets following strong gains over the past 6 months?
Yeah, it's an interesting question because if you look at the fundamentals for China, obviously they're still pretty poor. But what's driving markets at the moment is progress on reform, but probably more importantly, the significant increase in liquidity that's being provided by the central bank. So we've seen an acceleration in monetary policy easing measures. We don't really see that stopping, so we see that boosting stock markets, probably both onshore and offshore. But we prefer the offshore market just to the valuation discount that we see in the offshore market. So 8 shares look like they're going to outperform, in our opinion, the onshore market.
The US dollar has weakened markedly in the past month or so. Do you expect this to continue?
No, we don't. It's always difficult to time exactly when we're going to see the dollar strengthen again. But I think it's interesting to note that while we think that the first Fed rate hike will be in September, the market is discounting now December. So maybe as the market moves there, assuming we're right, that the market moves that consensus towards our opinion, that should support the dollar. So we'll probably end the bottoming out phase for the dollar and expect it to go on to make new highs later this year.
What is your outlook for oil prices from here?
Well, the dollar question is obviously pertinent to that discussion as well. So one of the factors that's been boosting oil prices in recent times is the weaker dollar. We've also got some signs that demand has been picking up, although that's inventory restocking and official stockpile building in countries such as China. We believe they're largely temporary, and if we look at the supply side, we still see an oversupply of oil. So we really don't see oil building on gains from here, and if anything, the risks over the next few months is to the downside for oil prices.
Thank you, Steve. We'll see you again next month.
Thank you.